And Cameron, I think we'll turn it over to you. Certainly, I know the OSC agenda. There's a number of changes, leadership changes taking place. It's a very full agenda. Our last director series actually focused on one of the topics you're spending some time on. That's around diversity, gender diversity on boards. For those of you that missed it, you can go to our website to see that broadcast on that particular subject. But Cameron, with that, let me turn it over to you.
Okay, thanks, Don. I appreciate the opportunity to be here again. It's always a pleasure to be here at this event. So I thought I'd start by talking about some of the initiatives that the OSC has been working on over the past year that might be of interest to you. And then thought I'd talk about some areas of financial reporting that we've been looking at the OSC that would be of interest to you as well. And I should start just by saying that the views I'm about to express are my own and not the views of the OSC or its staff. So as Don mentioned, last year we introduced some new requirements for disclosure about women on boards and in executive positions. Some of those requirements are things such as the number of women on boards and also any targets that are in place, among other things. The objective of these disclosure requirements are really to increase the transparency of what's going on in the corporate world in this space, to allow investors to make an investment decision and for voting purposes as well. Last year, the OSC staff conducted some reviews of disclosures in this area, looked at about 700 public companies and how they're doing in disclosure in this space. I think some were surprised by some of the results. 51% of the companies looked at had no women on the board, and 40% had no women in executive positions. So that might have been surprising to some to see those results. And the results also indicated that there does need to be a bit more guidance on how to provide this disclosure in the marketplace. And so a staff notice was issued last year to provide some good examples on how to provide that information to the capital markets. So have a look at that staff notice to look at some good disclosures. And I think the conversation is going to continue on this topic over the next several years, I'm sure, as this topic continues to advance. The second topic I wanted to talk about, regulatory initiative, is there's some new mechanisms for raising capital. An offering memorandum prospectus exemption is now in place that allows companies to raise a limited amount of capital without a prospectus. There's also a crowdfunding regime in place, and that allows businesses to access capital from a large number of investors online. So that's something that's new. The OSC also released proposals on a whistleblower program. So this is really to provide an incentive for individuals to report wrongdoing in the corporate world. The proposals that are out there now would propose that a whistleblower could receive up to $5 million for reporting serious securities-related misconduct. That's actually increased from the original proposals, which only proposed $1 million. And I think that's just to reflect the comments that people thought that they wanted higher up executives to have an incentive also to report. And so that's some of the thought process behind that. So spring 2016 is the objective, to have something in place. And so you can look forward to that requirement, those proposals. Yep. Lastly, venture issuer requirements are now in place. So this is really to streamline the regulatory burden for smaller companies. For example, instead of full-blown quarterly MD&A, smaller venture issuers can prepare a highlights document that just focuses on operations and liquidity. And really the objective there is to streamline the disclosures for investors so that they get the right information for the sector of the capital markets. So the next topic I wanted to talk about was some areas of financial reporting that we've looked at over the past year. Every now and then we like to look at new standards that are in our capital markets, and the fair value standard is fairly new. It's one of those ones that we thought we'd have a look at this past year. In the REIT sector in particular, we had a look at that sector, given the real estate sector is quite active and strong. Overall, on the disclosure requirements in fair value, we found a lot of the disclosures to be quite general. If you look at the example on the next slide or in your package, here's an example of some sort of general kind of boilerplate disclosure. Talks about an investment property measured at fair value, talks about being based on market evidence, talks about valuing the properties internally and externally periodically, but doesn't really provide any useful insights about how that valuation process works, who's involved in the process, and what the evidence is to support those values. Whereas on the next slide, the next example, this is an improved disclosure. Talks about the valuation team consisting of knowledgeable individuals and fair value techniques. Talks about how management reviews those results every quarter. 40% of the portfolio is appraised independently and annually. So you get a flavor about the frequency of valuation. You get a flavor about who's involved. Lots more information. And in summary, I'd like you to think about providing entity-specific disclosures in this space, really providing important information about fair value if that's something that's in your financial reporting world. Other topics that we've raised comments on over the past year are on the slide as well. Impairment of assets. One of the common problems we find are having projections and assumptions that aren't quite supported. So for example, if an issuer is in a sector that's not doing very well, perhaps a commodity that's not doing very well, yet there's no indication of any impairment whatsoever or any discussion of why there isn't any impairment, that's kind of a red flag for regulators. And so having too optimistic assumptions or too optimistic projections coming into those recoverable amount for impairment is something that needs to be focused on. Operating segments is another hot topic. Sometimes we'll encounter situations where there's not enough operating segments identified in the financial statements, yet you look to the MD&A and there's lots of discussion about different features, different aspects, different sectors of the business that you would think are operating segments. And so we do raise comments on that topic as well. Business combinations is the last thing I wanted to mention. Again, the topic that we see here is significant goodwill being recognized without enough intangible assets being broken out. So a lot of times companies acquire another company. There's a lot of value in there, and really companies need to take the effort to find out what those assets are that they're acquiring, especially in the intangible asset space, and recognize those appropriately. These topics can be found in a staff notice that we publish every year. It's CSA Staff Notice 51-344. There's a lot more topics in there. Feel free to have a look at that. I'd encourage you to do so in thinking about some of the things you may need to think about over the next financial reporting period. Don, those are the things I wanted to touch upon. Back over to you. So,
Cameron, I was taking a look at those improved disclosures for the REIT sector, and clearly much better disclosure in the second example. The other thing that popped out to me is much longer. So obviously we'll have to balance, and it's a theme we're going to be talking about today, is making sure you spend the words on the right area, and other areas condense that. So we'll touch on that. But the other thing I wanted, Cameron, your comments on, we're going to try to broaden a theme today is out beyond the financial statements and start talking about the MD&A. And of course, you have your continuous disclosure review. So any tips and key things that pertain to, for instance, the MD&A that you can pass on to our audience?
Well, the key with MD&A is making it relevant and useful for an investor. And one thing that we do often find in poor MD&A is just a repetition of the information in the financial statements. So for example, revenues went up by X% or revenues went down, without giving the context of why that is the case. Did revenues go up because there was a new customer that came on stream, or new products that came on stream, or likewise did revenues go down because of that? What's the reason? What's the insights behind that? That's really what's important with respect to MD&A, I think. And we're going to talk about this a bit later, but duplication can be a challenge, right? We've got a lot of requirements in financial statements. We have requirements to disclose information in MD&A. So try to think about how to avoid that duplication. Investors don't always need to see that information in both places, and can you think about perhaps doing some cross-referencing from the MD&A if necessary, or just thinking about what really is material.